many fund managers are looking to grow and are looking to do some fundraising this year. We're in April, but I think we're in a good place to have this discussion. So moderating this panel is Agnes. Agnes is going to tell us how she pronounces her middle name. A round of applause for Agnes. So Agnes Chisule is the managing partner of First Circle Capital. She's, Agnes, how do you pronounce your middle name? Okay. I hope you got that. All right. So I'm going to hand over to Agnes at this point to invite the panel and take it from there. Over to you, Agnes.
All right. Thank you so much. Thank you so much for having me, and I hope you had a great day so far. My name is Agnes Eisleitner Chisule, and I am the co-founder and managing partner at First Circle Capital. We are a pre-seed and seed stage fintech-focused venture capital fund, doing mainly deals in sub-Saharan Africa and North Africa. We have a portfolio of around 20 companies, and we're expanding that one. I would now want to call my fellow panelists onto the stage, and we will today talk about fundraising from the perspective of a company on what to avoid and what kind of recommendations we have. Please. So, some applause for Aiko, Richard, and Crystal. So I will ask them to briefly introduce themselves and what they're doing. We're having the perspective of an entrepreneur, of an accelerator, and of an advisory business, essentially. Crystal, if you could start with your introduction.
Sure. Hopefully there's no echo. Are we good? Great. Hi, my name is Crystal. I'm a principal at Open Capital. We're a management consulting and financial advisory firm working across 28 countries in Africa. We've support for the purposes of this conversation. Maybe I can share sort of like the ethos of why we exist is to build African economies, and we know that capital flows and transactions are a huge part of building African business. So from that, we've supported businesses, investors, and development partners in placing over $1.5 billion across the continent, and continue to do a lot of work across our countries and have a large office here in Uganda, some people in our team across there behind. So yeah, happy to always to dive into a lot more of the kind of work we do. We provide consulting services, transaction through our capital markets, have innovation side where we build accelerators, venture builders, and other innovations that we know would accelerate specific markets. We are sector agnostic. And yeah, happy to share more as the session progresses.
Thank you so much, Crystal. Now over to Richard.
Yeah, good afternoon to you all. My name is Richard Zulu. I'm the team principal at Outbox. We are an innovation and entrepreneurship support organization. Our main mandate is to support early stage, small and growing businesses. We exist to fill the missing middle gap, which is businesses that are largely struggling to raise higher ticket sizes because they're considered uninvestable. We're talking about $500,000 and above. So we focus on businesses that are trying to raise up to $500,000. So we provide the financing together with our partners to kind of de-risk their growth and scale to get to that level, and fuse that with technical assistance. So we largely implement through incubation, acceleration programs, and other business advisory interventions. We currently have the largest aggregation of startup funds for the market with various partners that we are currently deploying and then working with different entities to support with follow-on financing. Thank you.
Thank you so much, Richard. Now over to you, Aiko.
Thank you. My name is Aiko Ongodia. I'm the founder and CEO of Zeno. Zeno is one of the few companies that has specifically targeted the investment segment of the economy or the financial services sector to identify a problem, which problem is essentially very, very many people, most people find it difficult to plan, to save, and invest to meet their financial obligations that occur in the future. And so what Zeno has done is essentially deployed technology to help people essentially come up with an investment plan, figure out how much they need to save to meet that investment plan, and then how to invest whatever they put aside to meet that particular obligation that they face in the future. When we started maybe 5.5 years ago, outside of brokerage accounts, which everyone is familiar here, the Ugandan market had maybe 2,300 investment accounts. And so that was a very, very small base to start from. And I, with my team, together with all the other industry players, have managed to move that not only to add another zero, but to more than 50,000, 60,000 investment accounts. We currently account for a significant majority of that. So when we say we currently, our deployment of technology currently accounts for a significant a percentage of that. And so we have, as a company, walked through the journey of entrepreneurship all the way from ideation. You have an idea, which idea is essentially a hypothesis, so you need to design a small experiment to validate it. Then once you validate it, you have to approach the regulators to say, let me start taking customers. And then to approach the regulator, you require some financing. How do you figure out how to get your first initial financing? What do you need to validate before you get your first initial financing? And then once you get that initial financing to get you the first few customers, and then you still haven't broken even, obviously, so you have to figure out what are the key milestones that you need in order to unlock the next set of financing, and what sort of experiments do you need to run, and what sort of shape do you need to be in, and who do you need to actually also approach as well. Thank you.
Thank you, Aiko. All right, so basically, fundraising is one of the more important phases a company has multiple times over its lifetime. Very few companies are in a privileged position where they can just grow without outside funding. So fundraising can be from raising debt to equity. As an investor, I get all kinds of strange approaches. So what we're going to cover as a first question is like, what are the pitfalls that a company fundraising should avoid? For example, it starts from the outreach to an investor to how you present your company, what materials have to be ready, and generally, what are we seeing in the market that entrepreneurs are doing wrong that keeps them from raising those funds? All right, let's start with you, Crystal.
I actually want to push back. I think the team that put together this panel did an interesting thing where we have an entrepreneur, and then we have Richard Zulu, who's working with the startup space. And then there's us as well, working with more growth stage and larger transactions. It might be more interesting to start from the entrepreneur himself and then move down to the rest of us too.
What mistakes did you make?
I'll take one. All right, I didn't know how to work this thing. So I'll take one for the team here. So the question was,
what are the mistakes that entrepreneurs are making? Like, for example, you raised a lot of funds successfully. Like, what did you do wrong that cost you time or even cost you a potential investor that you would have wanted to close?
So the first mistake is just not knowing. Like, like not knowing, for example, who you need to pitch to, first of all, and what sort of enterprise you have. Because all enterprises, all types of enterprises can get funding. It's just what funding, right? And so, so as an entrepreneur, I might not be able to speak to a person that has a fish farm or wants to set up a piggery, etc. Right now, I'm just going to narrow down to the sort of sequence a technology entrepreneur goes through before attracting funding. So the first thing was, one, we had to be solving an actual problem that people face, right? So there's all sorts of ideas, and I have to say it here, I might be one of those people that got funding at the idea stage. So, but it had to be an idea that is a solution to an actual problem that people face, and you can speak to that problem. And so sometimes we have an interesting piece of technology, or we have an opportunity as well, but you can't really speak to the opportunity. You can tell the story of the opportunity. You can tell the investor how suited you are, or how your background has prepared you to solve that problem. So we begin pitching, or in our case, in my personal case, I had this idea. I just dropped out of a PhD program, spent all my money at school, paying school fees and living in an expensive city. So instead of getting a job, I decided to start a company instead. And so starting out a company, of course, you have this idea, but you need help from another person or two or three. So you can't really build out the entire company yourself. So you need to bring people in. And in order to bring people in, you might need to pay them. So in order to pay them, you need to have some money. So I started pitching, and I was not very successful when it was just at that stage. But I needed to do some work first to validate that even the idea I was pitching. So that's the first step. Have an idea, but validate it first before you look for money.
To summarize, basically, a lot of entrepreneurs make the mistakes. They haven't proven their model yet. Like now we're talking about the businesses that are early stage, that are not yet. I mean, it's a different thing if you're deciding to start a bakery. That's a pretty established business model. So it's also like you'll have to still argue, okay, I need this kind of funding from this kind of person. Another thing you briefly mentioned, I think, is what I see as well. Like I'm a venture investor, but I still get people pitching me their farms or whatsoever type of businesses, even though that's completely not in my mandate. Always it's like something to really avoid is like try to figure out who is the actual investor that can work with you, because you are within their mandate, you fit their criteria. And is it actually equity capital that you need, or do you need debt capital, right? So Richard, working with very early stage companies, like what holds them back from getting investors? Where do you see the problems?
Yeah, and I'm going to speak from an early stage mindset as we transition. One of the challenges, and it's not a mistake per se, but it's this perception that there's free money out there. The reason as to why, for instance, we partnered with a pension fund and deploy startup capital under an equity instrument is to drive this huge mindset change at scale. So that by the time these entrepreneurs, get to other potential investors, there's a bit of mindset shift and better ambition in terms of how large they're thinking. But throughout all this, one thing is sticking out, and it's becoming quite difficult whether we need to blame the accounting profession or we blame the entrepreneurs. And there is a very big disconnect between when you look at the audited books and you look at the business model of a business, they are totally not speaking to each other. Very, very huge disconnect, to the extent that I am very ashamed to share some deal books with certain people, because now we have to read, we spend a lot of time just helping the entrepreneur articulate their businesses through the financials. And I told them, if you ever get an accountant or an auditor, the very first question you should ask them is, tell me about my business. Do you understand my business? And if they can't break that down for you, then they can't do that. Because the impact of that mistake is just carried forward and forward. It's carried forward in your taxes, it's carried forward in your conversations with investors. They will run these industry benchmarks, they'll run all these margins and ratios, and it won't totally make sense. And you won't really understand that this is something that began from a simple mistake of you being able to articulate what your business does and reflecting that in your accounting books. So it's really, really massive. So that's the first mistake that we're seeing over and over again. The second aspect that we see is that many entrepreneurs think that it's about the individual. From where we see the investor, it's about you operating in a market that is growing, that might provide a potential for an exit. Then finding the best manager in that market, right? And the articulation of that is a very huge struggle for many entrepreneurs as they're trying to demonstrate that potential that I talked about earlier. Yeah, so largely for us, those are some of the aspects that we're seeing that are creating these barriers.
All right, but are you talking now early stage technology businesses or regular businesses?
I'm talking about, pardon?
Are you talking about technology businesses or regular businesses?
I'm talking about all, because we are kind of sector agnostic. Yeah.
Okay, because I mean, just to give my addition on that as a technology investor, what we see in the early stage is most of the time that because getting innovation to market requires a lot of mental flexibility. So you can't really map out the business plan too well. And there's a lot of changes as a business goes from early stage to seed stage, like pre-seed to seed stage. So I get your point about the financials, but I wouldn't, especially for the technology side, I wouldn't necessarily see that as a big hindrance for the fundraising. However, I would see the entrepreneur being able to articulate how they are moving along to capture that market and what they've been testing that has more, helps them more to attract investors, because they want to show, okay, we've tried this didn't work out, now we're trying this. We're nimble enough to adjust as our initial plan doesn't work. Because that happens very often in this industry. It's a bit different, obviously, for established industries.
Yeah, but also there's the appreciation that, when you look at it from a unit economic perspective, there are patterns that have been established. Even when you're innovating, right? You kind of benchmark against a certain pattern of how you really think about your financials. And not being able to articulate that to the next professional who's helping you kind of put your financials together is a really big hindrance for any further discussions you might have thereon, right? So even in the disorganization, there's organized chaos. And if you're not able to kind of put that forward, then it will carry forward.
Definitely. I mean, we're talking pre-seed stage only there. At seed stage, you have to have everything in order if you want to continue your fundraising journey. So now back to you, Crystal. What's your take on this?
Yeah, I think there are a couple of things, and I'll categorize them. We can think about compatibility, scale, complexity of business, and I think it's almost important for this audience or for this room to understand the different buckets and what exists there, right? So if we're talking about what are the different types of businesses and how does that match, even when we're thinking about higher or larger stage transactions that we focus on, it's important to understand what kind of business you are and then what kind of investors are coming alongside it. So if we're sharing what are the kind of businesses, because you're talking about tech, AECO runs a tech business too. I think a lot of the portfolio that Richard runs as well has tech, but also is now increasingly across and is more sector agnostic. But how to think about it? And you'll talk to different funders and even the underlying DFIs and others that provide the LPs for most of the funds or the private equity or other debt providers in the room. The way we think about businesses, you'll hear words like invisibles and bootstrappers and gazelles. But also, I think there's been more emerging definition of what businesses are. And it's important to understand the part about the business, and I'll get to the other parts of investment. But just to clarify how we all think about businesses. There are businesses that are focused on sustaining livelihoods, and a lot of those tend to be in that invisibles category. You're raising really small amount of money, but it's because you're a family business, you're replicating an already existing thing, you're working with rural populations. A lot of your growth plan is scaling that work at that scale. Right? And that's a business that's focusing on livelihoods. Then you look at dynamic ventures, and that's where a lot of businesses in this Ugandan market sit because it's bread and butter industry. So things like retail and transport, trade, manufacturing. A lot of the growth there is not grand, right? But there is huge return, and they're actually the kind of industries that drive jobs, which is the type of impact that we're looking for in many cases. And then you have niche ventures that are looking at particular impact or scaling particular industries. This is where you'll see things like creative or those that are trying to provide particular service industries as well. I would call those niche ventures that are prioritizing goals within the industry that they're in over scale. And then you have your high growth dynamic, and that's where you'll see the really sexy tech businesses and others that are also trying to do a lot of scalable hardware and more provision service businesses. And the kind of investment that's needed across all those buckets and types of businesses is different. And as you'll see with the dissonance across the people on this stage, it also requires a different type of investor. And the type of investors, and this sums up my point about compatibility, is you have profit first, who are more the commercial type investors, and then you have impact first, and then you have everyone who's in the middle. A lot of the other funders in this room are really sitting in that middle, that are looking at a combination of value creation for their underlying funders with financial return, but also social impact. And that's everyone in the middle of commercial and profit first. And I think the kind of issues that arise is typically with businesses mismatched across that. As you've called out, Agnes, is a farmer reaching out to you who is a venture capitalist looking at tech. We also see that dissonance even when we start thinking about the scale ideas that businesses have. And it's important that a business knows who they are and you know, the cliche, why do you exist and what is your why? And once you outgrow what is your why, which we're hoping you'll outgrow and leave that idea stage and get to market, is like, are you doing it well? Do you actually have the systems that build? Because as an investor, we're now hoping that you're building systems with Richard, right? You're working with him to build a firm business that thinks about their product and their market. And now we want to think about growth capital. And what are the gaps that exist there? And I think a lot of what happened there is inexperience with understanding what investors are saying, and also a mismatch in understanding how the investment process works. if you need money for working capital that is due in June and you're trying to raise in February, you are late. You are late to your investment story. And you should be thinking about a lot of those things earlier. So maybe to come to the other issues, or rather other points that I think are important to understand that we typically see businesses fall through, is not understanding what are the typical investment cycles, what are the different instruments that you should be looking at. Why are you talking to an equity investor when you need trade finance? Why are you talking to a debt funder when you're thinking about equity? And also understanding what their different processes are, right? So if we start from like the beginning of your cycle, do you have the right materials? And I think people get fixated on, I have a template for a financial model. Someone gave me a nice template for what a business plan looks like. It's really not about the design of the templates. It's nice to have nice materials, but what do they actually really say? And do you actually have a growth plan that means something, right? Do you have a strategy that actually is going anywhere? Do we see projections that are showing that you will have financial return? Are you making up your market assumption numbers? Are you telling us that you're going to, myth bust and like create value in an economy that is a bit of a lie? So you should be, grounding a lot of those numbers in reality and thinking through what is your strategy, who do you want to be, what do you want to grow, and once you have that articulated, it now becomes, how are you doing investor outreach? What kind of conversations are you having? And that plan for market, I was talking to someone from the CMA yesterday who asked, how can you help us reduce the time between when an investment is ready, or not actually ready, it was like when they come to you to help them raise capital, to when why is it so long? How can we reduce the amount of time? And it was like, listen, we have to start with, does the strategy the person's even coming to you making sense? I was actually having this conversation with someone in the room about an investor. If you're a tech firm, we're talking about growth, and then you come to me about a CapEx investment for us to set up a factory. There's clearly something that's a bit off in the story that we're talking about, and we need to align and think through that strategy. Like, what do you actually want to grow? And a question about your strategy always if there's a gap there, the first thing for us to ask is, do you actually have a good team? Do you have a CFO on your team? Do you actually have someone who's holding you accountable for the kind of questions you're saying? Because you can't just dream, especially if you're coming for growth stage capital. And that means that you already have laid out everything and you've existed for a while. So if we've worked through your strategy and agreed that this is what's going to happen, and you're having these investor conversations, it's important to now manage your expectations. Every investor has a different cycle. There's a number of due diligence sessions, and that's where you should start getting a lot of your financial reporting in check. That's where a lot of the things that you should have in terms of articulating and having your governance in check. And this is where it's different from when you're talking to an early stage and a growth stage business. Your governance is really important. If the private equity table over there with Carol and David find out that you are trying to get equity and have never thought through a governance structure, it really doesn't work. You're going to spend so much time in that diligence process thinking through how you're going to have a board, who's on your board, how does it work, what are the seats. That delays the process, and also means you weren't yet ready for that structure quite yet. You haven't yet thought through that. So if you're moving away from that and you're going through the diligence things, and I think I don't want to detract from some of the back and forth you were doing about early stage, but I'll say for growth stage businesses, and I think it was great that yesterday we had the head of the CMA call it out. Governance and transparency is extremely important to improve investment opportunities for the country. You should have, in fact, if you are defrauding your investors, you're spoiling it for everyone else. So get yourself in order, because if you have 3 sets of books, they all have detractionary, or you've just deleted your entire balance sheet to hide debt, the market is small. We're all talking to each other. We all know who owes what, right? And they will catch you. So in the event that you're coming to an investor table by first hiding who you got money from, it's not going to work. You actually have to get yourself in order and be honest about it. And then I think it's a lot of the conversations that you're going to have. If you've made it through DD, you've made it through relationship building with your investor, and are now thinking about different term sheets, it's making sure that you understand what the terms are, because you're going to leave the table, you know, completely disgruntled, or the investment will take shape and then we'll come back and you're arguing about it because you didn't really understand what the investor controls were. You didn't really understand what it meant for your board. You really didn't understand the terms for the interest, or you didn't understand the type of investment tool you took. We hear a lot of businesses that are, I would say, less exposed to the investment process telling us, I don't want those guys, I want a convertible. I've heard about mezzanine because it became very popular in the news in Uganda a while ago. So now everyone wants that, but you don't even know what it means. You don't know what the conversion triggers will mean. You don't understand why some of them might still want security, or you're just excited that it feels like free money and it's not. So making sure that you understand what some of all those events are going to be and what their perspective will be, and managing your expectations. If you go through all of that and you're successful, managing your expectations about when the money will come to you. Sometimes there's a huge lag between when we say yes and when the money actually comes to your bank account. I'll pause there because I could always rant on and on. So Agnes, any other things?
Thank you, Crystal. Yeah, unfortunately we're running a bit out of time and we still want to have some time for questions. But before we go into questions, like, what is the one thing, quickly, each of you, what is the one thing that you would recommend that for entrepreneurs when fundraising? Just the one thing, very briefly.
Yeah, just what sort of enterprise are you? Are you an enterprise that is going to follow the venture track, or are you a small and medium enterprise, or are you a social enterprise? So that's really, really important because each track has a different sequence and different milestones.
Thank you.
Yeah, so after you're self-aware and you understand your business, look at investment raising as some form of relationship building process. I feel that's very critical, and many of us miss out on that opportunity to close because of that. There's an element of empathy in investment. Yeah.
Very true.
I'm quite long-winded, so I won't make one point, but I'll make one sentence. Right? Does it work? So yeah, I think businesses should, one is understand that as much as, I think it was Richard who was saying that people don't bet on people, they actually do. You want to work, you want to invest in a business you believe in. The first point of review is this entrepreneur good? And an entrepreneur should be has the unique place where they have to be both confident and humble, right? Confident in your business, confident that you can run, you have a good team, confident in the systems and processes you set up, confident in the idea you have. Humble to know that investors have seen the whole world and they actually also want to help you. And when they poke these questions, they're not trying to one-up you. They've come to the table to actually support your growth, right? So if they're going to do that, be humble enough to now build a relationship, because some of these investment tracks are long-term. So I can go on and on about how you should have strategy, you should have growth, you should think about this, but remember that they're betting on both financial success and operational success to achieve any of the returns that you have. And they're betting on the business, and you should be confident and humble enough.
Thank you so much. All right, let's go and take some questions from the audience now for the last 10 minutes or so I think we have. All right.
Okay, as I take the mic, if I may, I have a question. I'll probably start to any one of the panel. I just got intrigued when Crystal mentioned that she had a chat with I just wanted to ask that much of the presentation today has been to the entrepreneurs. So there is a key issue. Sometimes the process is longer. What I'm hearing is because most times the process is longer because you've brought up a business idea and it's quite misaligned. So I'm still thinking, I would want to know, do you think there is an opportunity where regulators, like that gentleman or lady from capital markets was probably trying to inquire, are there ways that they can come in to sort of educate perhaps, or help the likes of yourself, Crystal, the providers of this capital maybe, or the mobilizers, to make this process a bit shorter? But most importantly, how do you see yourselves working with programs like the Accelerator for Startups that Alan is very passionate about, or is working with startups? I believe those are all avenues that can, in a way, or is in a way helping cure how you craft a very comprehensive business idea, for example, especially for startups. Just to hear your thoughts on that. Is there anything that can be done to make sure that people have aligned businesses, or they are well thought out? It's not like I'm tech, then because I'm seeing a business opportunity in agribusiness, for example, I want to jump on that. So is there opportunity that any other person can tap into this space? I believe it eventually helps your process become shorter and easier to evaluate. Thank you.
I can answer the question around timelines, and it might not be the best, Lisa, but let me say it this way. Investor cycles depend on who the investor is, right? We started by saying you should know your investor and the people that you're reaching out to. Even as Open Capital, our breadth is wide. We work with 300 investors. The reason for that is because everyone wants something different, and they all talk very different language. They have different ICs, investment committees, and it's also because they have different LPs that dictate their mandates, and so their processes all look very different. So you should come to it very aware of that. It also depends on what the instrument is, to be honest. Someone with debt might give it to you a lot faster than someone who now has to sit down and think about an equity deal, and everyone else in between that. So it's going to depend. The way to make the process shorter, and I think this is where things like accelerator programs and so on are really interesting, is to ensure that you're already preparing yourself. And this is why I said at the beginning that the first thing is that if you're thinking about investment when you need it that month, you are working so late. So you intuitively should have a fundraising strategy aligned with your growth strategy. You should know from the beginning that you're going to be raising funding. What is the funding for? Do you need a bridge round in the middle of that to create a milestone that enables you to open that capital? Yes. If that exists, then let's also work on that. If you need to have if you're going to work on a pure equity deal, to be honest, if we're talking about it and you say you need the money in 3 months, you're a big joke. That's not just how it works. There's like 6 rounds of DD, there's several investor building, but I'll also give you the best analogy, right? Because I think it's important to understand it this way. The most important part is it depends on the instrument. A commercial bank can give it to you in 3 days, maybe not, right? And the bankers in the room can tell you that. But if we're thinking about it as a pure equity deal or a mezzanine or quasi-equity type deal, remember that you're entering into a marriage. Is there anyone who marries someone after 5 minutes? No, right? Are there ways you can shorten it and ask the right questions to get to understand that marriage? Probably. Yeah, sure. There are things we can do. We can dress you up really smart. You'll know the right questions to answer. You'll come for the first date and know the right things to say. You're really on point. The second date, we discover maybe, yeah, we don't agree on a few things, but let's find a middle ground. Right? So you're building a relationship with an investor that you're going to have for a long time. And remember that you actually do want a long-term relationship. So if it's to build it on a strong ground and make sure that marriage of minds with the money that you're getting is actually worth it, then maybe the long-term line is not too bad. Allow them to get to know you and provide solutions so that it's actually a marriage that's worth it.
I would like to add something here, especially for the early stage business. Like it's not enough to just have a business plan or generally an understanding of what you want to do. I always hear like, I couldn't do this because I couldn't get funding, and that is not true. We live in a digital age. You can at least find a few ways to validate your idea, even for a bakery. Like you can go out there, you can start posting about these things, you can start showing, hey, I'm building a crowd, I'm doing something, I'm serious about this business. Because if you really want to do, like if you really want to be an entrepreneur and if you want to be successful in business, that kind of has to consume you. And you have to be able to show that, even if you don't have the money yet. You just show, okay, I'm building a community, I'm doing something with the little that I have, and that can be a phone in this case. So this is something that especially early stage investors we like to see, because that also shows, okay, this person is serious and dedicated and not just spent like a few hours writing a business plan and got excited about a certain thing. I want to see that you have some skin in the game, and that even if you have a job, like after the job, you do the night hours and you just work on that business. Because everything else is just like, you're not really serious. Because if your idea depends only on somebody saying, oh yeah, okay, I believe in that, this is never going to work out, because there's so many other hurdles coming up along the way. And that is something I would highly recommend anyone who wants to push people to be more entrepreneurial, but also to get funding later on, that they also focus on what can they do with at that moment before funding that also helps their business. All right, let's move on with other questions.
Thank you very much. I am Emmanuel Juko of CZG Associates. To Zulu, I'm very, don't know the right word to use, but I'm very concerned that you find the integrity of accountants questionable. I'm an accountant by profession. And I can guarantee you that if you told me to come and explain to you your business, you would fire me before I even start. Because you actually are supposed to help me understand your business for me to determine whether I can take you on or not. But you raise something very, very important, that financial statements sometimes do not mirror the circumstances of a business. And I would want to agree with the people that have spoken before me when they say that the entrepreneurs in Uganda are faced with cultural constraints. We do our business individually, and we understand our figures. As an entrepreneur, I know what is in my bank account. I know how to play my game. So when you come and you tell me to explain things to you that you have not explained to me, I can hardly do that. And then we have, when you see, why do people have business plans in Uganda? Why do people have audited books of accounts in Uganda? Not many people sit down to actually articulate their business ideas. People come up and they only want to do a business plan because the bank wants a business plan. So you find that they take it to some place and then they write a business plan, they put in whatever they put in. Before you know it, the newspapers are awash with things that are on sale. Why do people need audited books of accounts? Because of the taxman. So they do whatever they do that does not reflect the actual performance of a business, but because they want to run. As long as you keep the taxman at bay, the entrepreneur is happy with you. So we actually are in all this together. So we should actually think about how do we educate the public, the entrepreneurs of tomorrow especially, that we are not out there to winch hunt them. We are not, that we mean good for the enterprise they're having. We need to educate people that there's money out there for them to get, but then they need to put their systems in order. So I think it is it should be a collective responsibility on our side to actually educate the public about the need for their businesses to be professionalized. Thank you very much.
Excuse me, maybe there should be actual questions, I suppose, like to the...
I was just going to say, thank you for the comment. It doesn't sound like a question, or okay. Did we miss something? Thank you. Appreciate it.
Okay, Madam Moderator, if I may, we'll probably take just 2 more questions and then we can close out the session. Thank you.
Say, look, stop raising and focus on your customer. Because if your customer wants what you have, they'll buy. And if there's growth, the investor will come throwing money at you. That's for yourself. On the other one, maybe for Crystal, is there an opportunity, because entrepreneurship, startup is the new sexy thing. And I've been there, lost hair, grown old, and anyone over 40 who's not in business, I always tell them, look, don't even start. It's an uphill battle. Is there potential for acquisition entrepreneurship, where instead of having to start, figure out your taxes, figure out customers, figure out all these things, go and buy an existing business? I will pause it. Thanks.
Could we take them all, please, and then you can respond? That was
Yeah. Richard has very kindly whispered that I should answer my question first. He might have a very long answer about yours. I think there definitely is an opportunity for acquisition entrepreneurship, and I think that's why I was also at the beginning of this describing what are the different types of businesses that exist, right? So if there is an opportunity for you to think about consolidating a lot of niche ventures into something that could be more high growth, right? Consolidating a group of some of those high growth businesses as well, and taking over is something that's quite interesting. I was actually even talking about it today. Again, I have loved half the conversations I've had, by the way. So if I keep referencing people I talk to, I was talking about the transport space today, and where we lie in Uganda, what's happening with the mobility space as well, and half of the sort of informal sector and things that have happened there. It would be great if there were some great acquisitions coming. Unfortunately, a lot of what we see with strategic acquisitions is it's huge corporates taking over. So I don't know, Philip, if your question is around individual participation. If it's around individual participation as an entrepreneur, I think there's definitely an option in thinking about how you can consolidate what's existing and create and disrupt a specific value chain. It might be bringing together a number of those really small, for example, let's actually even think of a case study. When we talk about sustaining livelihoods type businesses, people working in rural value chains, you're thinking about those where maybe, let's talk about agriculture, they're working in the ag space, they're working directly with rural farmers, but then you'll have people like Twiga, right? I would almost think about that as if they were able to come over and take on those who are working on those smaller spaces and kind of consolidate that, sure. Now, to do an acquisition when you're not already working as an entrepreneur is a whole other thing, and I think that might make you even go bolder. Because if you're not already a strong entrepreneur who understands a specific market, that's why corporate works better. They know that space, they've achieved certain values and metrics around that. I think it's easier for them to come in. As an individual, you need to already know that business and you need to have already engaged with it in that specific place as well. So I'd say that's the way I think about an opportunity. I think about it also within specific value chains. I don't think it would exist across all sectors.
Yeah, on the aspects of customers and sales, we've seen there are also types of entrepreneurs, and it largely depends who you get to interact with. There are definitely those who spend more time fundraising because it's the sexy thing to do than actually running the business, and there are definitely those that we've really seen really try to grow their sales as much as possible. But there comes a point where you cannot do that without outside capital or investment in whatever form or shape. And this is where this type of business comes in handy. Investment comes in handy, because then if you're able to demonstrate that, you know, I have sales and I'm really trying to grow to X and Y, then it can possibly unlock the financing. So there are definitely entrepreneurs who are very hell-bent on making sure that their sales work, but at the same time, they're very interested in trying to grow that portfolio by doing some fundraising. So they're definitely there.
All right. Do you have any other comment?
No, I was just going to add to what he said. I think there's and you forget my quote, right? Forgive my quote. There's an interesting rapper who said, "How can I help the poor when I'm poor too?" Right? And the reason I put that out there is I think that businesses the reason they're chasing capital is they're distracted by the need for runway, right? The reason why they're doing that and don't have the luxury to say, I'm going to double down, get my strategy straight, fix my pricing, not be in this windfall of always looking for working capital to get us out of the dump that we're in, and focus on getting the good bones of this business now, is because of that sort of lack. It's almost like a chicken and egg. If you can fix and sit down with a business to understand, is your pricing wrong? Are you thinking about cash flows wrong? Fixing those operational challenges first to help them get out of the dump of constantly needing to raise capital, then you're able to almost pivot your program for someone not to focus on access to finance. If you're constantly thinking about access to finance, it's because there is a cash flow issue. Why is there a cash flow issue is what you need to be solving for. So if they're already feeling constrained, and as I said, if I'm poor, how am I going to help the poor? They won't be thinking about all the other strategic issues. So I think it's almost also helping diagnose. So for those who are actually running accelerator programs or things like that, if you're able to help them understand where the gap is and why they're constantly in some of those pitfalls, looking for cash versus looking for growth money, then you can almost pivot some of that, I'd say, attention.
All right, thank you so much. Do we have another question for another? Do we have time for another question? She's at the back.
My proposal, apparently there are 3 burning questions. Okay. So we will take all of them.
Perfect.
And then all of them, then you'll respond to them at once, quickly and briefly. 1 minute. In fact, 30 seconds.
Yeah, my name is Sulabana, and I work for this second paper. Just one question to Aweko and Mr. Zulu. I mean, does any venture capital firm actually have any money that can help a CS startup prepare itself for its first fundraising exercise? I mean, even if it's $1,000 or even $2,000. I mean, does that money exist? Yeah, I'll be with you. Thank you.
Thank you. The lady? Yes.
Hi, my name is Diana.
After.
Hi, my name is Diana from Fundraising Capital. I have one question for Aiko. So you mentioned one of your lessons for entrepreneurs is being able to understand the difference between your venture track and an SME. So as investors and also yourself, we have a really bad basic terminology we do not understand. And the last 2 days we have been focused on private equity, but there's VC and my previous point we talk about VC funding. So what does this mean to be on the venture track versus an SME? Because this is very important in terms of what you've been talking about when it comes to investor mismatch. So just break it down, because we have fund managers and different individuals who will be advising potential pipeline for myself as well. I'm always looking for pipeline. So please just break that down.
Thank you so much. My name is James Nwagawa, a lawyer, tax consultant, and CFA Level 2 candidate. My question is in relation to the kinds of entrepreneurs we have in Uganda. A significant section of them are quite people with limited resources. And the panelists kept mentioning something about corporate governance and financial statements being some of the key issues they look out for when they're trying to look for investment. And most of these people, when you talk to them, they don't really have the financial muscle to meet the costs that come with meeting corporate governance requirements, meeting the financial statement requirements. And every time they look at it and they tell you, oh, James, that is an administrative cost and I may not be able to meet it right now. So my question to you is, what solutions are available for this significant section of Uganda's community in order to contextualize fundraising for those people? Thank you.
All right, let's start with Aiko answering. And we have one more, 4 questions?
Lisa, you have 1 question.
Okay.
Okay.
I don't like to go back on my word, but...
And then we are very, very quickly answering them.
Sorry about that. Quite quickly, this question goes to Zeno Ayeko, a person we have maximum respect for. Started the company out of, chaotic scenes. I just want to know, on the track to now stabilizing this business over the years, we now see the brand, there's a lot of belief behind Zeno. Do you know when you will be selling this company?
Thank you. Yeah, thank you very much. I can tell you for sure that back in 2016, 17, when I was starting out, if I'd pitched Mr. Zulu, I would definitely have failed. If I'd pitched Crystal, I would definitely have failed. And if I'd pitched Agnes, I would definitely have failed as well. This is because of what you started, is the beginning of a company is very chaotic, very uncertain. You just have an idea, but it's really an idea. So I think it's somebody from a certain radio station. I didn't see her face because she was seated down, who was asked the question. There is a social enterprise or lifestyle enterprise. There is a small and medium enterprises, and then there is a venture track, which eventually might graduate into private equity or go do an IPO. And so it's really important to identify which track you're on, because if you are a lifestyle enterprise, you are not going to be very successful with Agnes or Crystal at all. Yeah? If you're medium, small and medium enterprise, you might actually succeed based on his description with Mr. Zulu, because a small and medium enterprise more than likely has certain structures. But let me reduce, for actionable sort of insights, let me just narrow my submission to the venture track only. So what applies for the venture track does not necessarily apply to the other tracks, right? So I'll just narrow down to the venture tracks. And so, of course, while my colleagues were submitting, I was internally disagreeing with so many things they were saying, but because those things apply to different tracks or different stages, again, even in the venture track, what applies to a certain stage does not necessarily apply to the other. So it's identifying what is the track and what is the stage in that track. So let's just reduce. And again, this does not necessarily generalize to every enterprise, every situation, etc. But these are just highlights. One is you have to have an idea, fairly ambitious, and fairly solving a relatively large problem that this is for the venture track, that's a relatively large number of people face. And you can do something really, really small to validate that solution and then demonstrate it to whoever you're tapping that capital from, right? So just what is the smallest thing without raising capital that you can do to show, right? It can be maybe building a prototype or taking your first customer. So in our case, we could not take our first customer before showing the CMA the money, right? So we actually had to raise money before we could take our first customer. So if you had to raise money before taking your, ideally, you need to take your first customer first. No, there are many enterprises that exist in an industry where you don't have to show the that's not necessarily licensed, etc. And so then after that is the next milestone. Okay, right, you can take your first customer. Can you get to your next milestones, maybe 100, 1,000, etc. But very importantly, in those initial stages, you don't have a governance structure. You just have an idea. You don't really have, you might have a board of directors of a, but you cannot actually build an actual organization if you're 5 people, right? How many departments will you have and who will run them? Who will supervise who, right? But that is the, that's the trajectory you go through. You go from 1 person to 2, to 3, to 5, right? The configuration of your organization or your enterprise and even the funding that it attracts at 5 people is very different from the configuration and funding and the milestones that you have at 30 people, right? So it's just realizing what are the things for whatever track it is. In this case, the venture track, there are milestones at the stages. There's lingo, there's family and friends, the happy merry-go-round where your family and friends invest in your ideas. So that is the if you've never taken money from anyone, so I think it was Mr. Busula, I'm not too sure whether it is Miss. Yeah, all right, yeah. If you've never raised money, the venture capital firm is not necessarily the first port of call. It might be your family and friends. They call it informally the family and friends round. The next round after that, again, that family and friends round is to help you meet the next set of milestones. That next set of milestones is different from the first set of milestones, right? So after you meet that next set of, you go to the pre-seed, essentially. So that is the sequence that you use, and then after the pre-seed, you go to the seed, and on, all the way up to the growth stage, where you will meet Crystal at our office. Yes, thank you.
Yeah. All right, Richard, please, let's address the other questions quickly.
I hope they've answered your question around the 1,000, 5,000 tickets, family and friends. So you have to be very, very networked. And fools. The other day I was meeting an individual who was looking to invest 6.5 in a tech business, 6,500. So they are there. Yeah. So I want to speak to the financial statements question. Yes, true. Businesses have this as a struggle, and that's why interventions like what we do at Outbox do exist. It's to really build that capacity, because we are given the patient capital to bring the resources that are required to help you build that capacity. So a number of times we spend more time looking at, largely if you've been banking, we try to use your transactional records to get an idea of what your business is like. Even when you give us your audited books, we still usually fall back to the financial records just to get an idea that what we are looking at is true. Unfortunately, in every profession, there are those good and bad aspects to it. It's not to say that all accountants are bad, but they do exist, and we know them because we look at a lot of data. And there are some firms we've specifically said, if I see an audited book from this firm, I won't consider it, because that's what the data is telling us. If this year alone, I'm looking at 170 companies just in March, that's a lot of data I have to work with that can inform some of these decisions that we make. But that's why accelerators exist, and definitely there's a support system. Yeah.
I think we should stop now, or I will never be invited as a moderator again. All right. thank you so much, all of you. I had a fun time moderating, and thank you all for listening in. Thank you so much.
Thank you. Another round of applause for the discussants. We've just had lunch. Very insightful discussions there. I believe if you're looking to start up something or you know what to do to optimize your chances of getting funding and also making sure that you have thought out comprehensively your business ideas. We're going to have a short partner highlight from one of our key partners, that is IAVCA, the East African Venture Capital Association. As you see, it's part of the program. I would like to take this opportunity to welcome representation from the East African Venture Capital Association, IAVCA, to make just some few remarks. Not at the moment? Okay, so we will be moving to our last session for the day, and I would like to invite George Jato Otim. I would have called the other way we term him in this market, but I may be, should I not? So he has refused, and I would also like to invite So George will be the moderator for this session, and I would like to hand over to George. You are most welcome to take us through session 5, from private to IPO, emerging fundraising and exit options for SMEs and investors. I didn't hear Mr. Ayeko's response when they asked when he would be willing to sell. I was also very interested. As a potential buyer, you never know these things. Yeah, you didn't answer that question. Yeah. So you're most welcome, George. You can invite the rest of the discussants. Thank you.
Good afternoon, everyone. Just as Lisa said, my name is George Jato Otim. I'm a corporate finance professional. Head the corporate finance function at an accounting, tax and advisory firm. And Mr. Richard Zulu, I hope the BDO brand is not one of the audit firms that you review and you would be disqualifying anytime soon. But I do believe we are well positioned to advise so many of you here. And yeah, I come here also in the capacity of the board chair of, board treasurer of the East Africa, the CFA East Africa Society, as well as a board member of the ACCA. So do have a bit of the accounting background as well as the investment background as well. So without further ado, I would like to take this opportunity to introduce the panelists or the discussant for this particular session, from private to IPO. And I'll be sharing the stage with Bob Musinguzi, who represents the Uganda Securities Exchange. Then I would also like to welcome Mr. Patrick Oketa from FSDU. Okay, thank you. So from private to IPO, I decided to use the US as a benchmark to see how we compare ourselves, and the statistics are quite disheartening. So in the United States, there are over 58,000 listings. And if you compare that to their GDP, particularly the S&P 500, which are the 500 biggest companies in the US, if you look at the net assets value, the market capitalization, it is 33.85 trillion. Compare that to their GDP, the income that the country generates. In its totality, it's 23.32 trillion US dollars. So meaning that the assets of the United States, of the top 500 companies in the United States, their value represents 145% of the income they generate. Now, when you come to Uganda, it's a totally different story. We have about 17 listings on our stock exchange. That's the Uganda Securities Exchange, of which, if you look at their total value, it's 6.6 billion US dollars. Compare that to our GDP, it's just a GDP of $37.6 billion. And of these 17 listings, only about 9 are actually locally based, and they account for 1.84 billion US dollars. If you express that as a percentage of our GDP, it's about 5%. So that means that the assets that are used to generate revenue for the country, only about 5% is reflected on our stock exchange. So there's a lot to do in that space. So I would like Mr. Patrick Oketa to just give us an indication and understanding of what IPOs are and what it means to be a public company.
Good afternoon, everyone. I'm really pleased to see a lot of people in this space. A few years ago, when we were learning the practice of investment, private equity, venture capital, the space was really small and there were very few people, and I'm really pleased to see a lot of young people. I was looking at the CFA list, a lot of Ugandans playing in this space. When we were growing up, this practice was mainly done out of Nairobi, and Uganda was a place where you could potentially not find talent. But I'm really pleased to see the team growing. I remember when we were beginning our first private equity fund in Uganda, we recruited a lot of the analysts out of Nairobi. So I think this space is catching up. A lot of these convenings happen in Nairobi regularly, and I'm pleased to see the team growing in Uganda. The motivation to start businesses varies across, and I had the previous panel talking about how people mobilize capital initially. The trajectory of fundraising starts with, of course, friends and families and savings and building a balance sheet. When you build your balance sheet, the liability side is primarily funded by equity and debt, and probably reserves, or which could be tax reserves or revaluation reserves, and the asset side, of course, generates the income for you. So as your business grows, and I think it was important, as it was mentioned earlier, you need to have perspective of where you want to take your business from the beginning. If you're building your business as a lifestyle business, the understanding is that it's probably going to remain small. If you're building your business to grow it to the point where you're going to attract third-party capital, which could potentially be either debt or equity from private sources, or subsequently, taking it to the public, you have to have that mindset from the word go. So a lot of our businesses in Uganda are built for survival. Many of them are built as lifestyle businesses. If you look at the data out of the US, people build businesses from the beginning with the intention of taking it public. So I think one of the reasons why we have very few businesses that go public is because of the motivations, the reasons why these businesses were set up in the first place. So as you build your balance sheet, you eventually get debt added into your balance sheet. So you're leveraging the little equity you have and grow the business. So if you intentionally need to grow the business to the point where you're going to go public, you will, do certain things. Like earlier, the conversation was around how do you shorten the time of diligence. If you prepare yourself from the beginning with a good understanding that at some point I'm going to go to the market, the gentleman from the capital markets will tell us what the requirements are for capital markets in Uganda, but you have to start working on this from the beginning, from the word go. Whether you are raising your seed rounds, or whether you're raising your private equity rounds, your understanding should be, how am I going to get out of this transaction if your intention is to exit? Because a lot of businesses in Uganda have no intentions of exiting, so they'll subsequently remain small and not grow. But if your intention is to grow it and take it to market, you have to start working on this very early. So if you've got to a stage where you meet the minimum requirements of the capital markets, then the first thing you need to do is employ an investment bank or investment banker to advise you, to prepare you. So when they prepare you, they do diligence on you, they will do diligence on your operations, they'll do diligence on your commercials, on your financials, on your governance, and so on. And if they're pleased with what they see and it fits within what the minimum Securities Exchange Commission requires, then your business is given an initial prospectus. The initial prospectus is basically to test the market. Is there interest in this business model? Is there interest in this business? Because there is no firm that goes for an initial public offer with the intention of selling or underselling the stocks that they put into the market. So you go with the understanding that your business must be acceptable. So when you do an initial prospectus and you get lukewarm interests from the public, usually the investment banker advises you to hold on, to wait, either because your timing is wrong or because probably there are certain things lacking within your business. So once the market accepts your business, then a second prospectus is now issued. That is the prospectus that is going to have your price. It is the prospectus that will be taken to the Capital Markets Authority or the Commission for that matter for approval. And once that has been approved, a date is then agreed by the investment banker and the subsequent company, and then you go public. So when you go public, what are you doing? You're selling equity. So when you're selling equity, some of it could be primary equity, or others could be equity that already exists in the business and an investor wants to exit. Recently, we saw what happened with MTN. There was no primary issuance. It was a secondary issuance because the existing investors wanted to exit. But most IPOs happen when businesses are mobilizing capital to be able to grow their balance sheet. So those are the two reasons why people get into the market: to exit existing equity and to sell primary equity to bring capital into the business to enable them grow their business. I'll stop at that. Thank you.
Thank you, Patrick. So just as you mentioned, we had a most recent IPO, I think in 2021. That was MTN, and I think from 2012, in the last past years, we've had about 3. So coming from Umeme, Sepla. So Umeme in 2012, Sepla in 2018 or so, then 2021. So that's not also a really good statistic. And if you look at the key drivers of those listings, you notice that it's the government has had an arm in trying to ensure that these listings happen. So either the government is selling its stake, for instance, in Stanbic, or you're looking at regulations that are propelling these companies to eventually list on the stock exchange. So we, as the private sector, we need to come up with initiatives and ensure that the listings that are happening in our markets increase. So I'd like to ask Bob from the Ugandan Securities Exchange, what are some of the initiatives that have been introduced in the market, try to ensure that there are more private-driven, private sector-driven listings and those that have purpose, just as Patrick has mentioned. Thank you.
Judge, thank you. And we are really very happy to participate in this, because I think for us it's our bread and butter, and for some of us it's a KRA somewhere in our scorecards. But I think Patrick gave a good background for this conversation, and I think the key point was motivation. Most of us start businesses either as side hustles. You're saying, okay, let me earn something to beef up my salary or something, with no intention. Now, this normally tends to cause an issue and kind of a bottleneck for companies to come public, because you'll find somebody's okay. Sometimes I think from the previous discussion, there were conversations about the accountants, but sometimes it's not their issue. Because somebody says, as long as I can get something, it is okay. And somehow, either due to hard work or better utilization of opportunities, this entity somehow survives that business mortality rate. And 3, 4, 5 years, even 10 years down the road, this company is there. Now, the key bit about coming public is opening up. Now, when it comes to this entity to open up, the first, I think Patrick referred to the due diligence, the first torchlight that hits there will always see a problem, and the conversation will always end there. There are so many. And then the other issue is, I think also from Patrick's preamble for our conversation, is around the intention. It still circles around the intention, and then the preparation. So from where we are from last year, because this is an issue we have dealt with, and we said, what can we do in our space to try and shorten this gap? So we came up with an intervention. We just codenamed it a DALA, just as it is in English, steps. How can we get companies that are interested and we start them on a journey? So it has 2 aspects to it. One is, can we get companies that at a certain level, we interact with them, at least try to give them some guidance and see whether they can reach a certain level of investor ready as the exchange. Now, in here, we focus on at least ensuring certain things are in place. Some bit of governance, some bit of openness, disclosures. A company is going to be able to do some financials. Are their financials in the right order? We only have 1 set, not the 3 sets I think somebody referred to. Now, the other aspect we look at is now for some that can actually qualify for the market. Now here, the main focus is around governance. Do you have a board? Do you actually meet? Or who controls what? Is it the CFO, CEO, MD? Is it one person? And then also, importantly, what is your story? What are you doing? So that if you're to come and pitch to most of you in this group, then you can understand that this person has a story to tell and a goal to achieve. And then in there, we also, why are you raising money? Because all of us want money, but why? Are you saying, I want maybe to expand? Is it the MTN side where it was somebody exiting or still a simpler bit? And then we try to see, is this something you can sell? So that is our point of intervention. And now I think we interacted with, I think, some of the members in our audience. And the question I think that was coming up was, aren't you now playing in our space? It came up. So we are not. All we are saying is, let's get these people from the universe and put them somewhere where they can be accessed. And then they are ready for you people to participate, to invest, but you start from somewhere. And I think the lady from Zit Open Capital was saying now, if you go to start from somebody in nursery, it is really heavy. It comes back to that question they asked her, how can we shorten this journey? And that is our intervention to try and answer those questions. Because at least you'll meet somebody who is somewhere, maybe in P1 or P2, they can write their name and basically be able to articulate themselves.
Okay. I'd like to add to that. Last year, or the previous year, Financial Sector Deepening Uganda, together with the Capital Markets Authority and the European Union, developed what we call the Deal Flow Facility. Now, the Deal Flow Facility sits with FSD Uganda, and it is a platform that we have built that brings together the demand and the supply side of transactions. So what the Deal Flow Facility does is it onboards investees that are potentially looking for capital. It also onboards investors, and I don't know how many of you representatives of investors are in this room who are members or who sit on the platform. So what this does is it gives transparency, reduces information asymmetry onto the platform. You will go and look at the list of transactions that are available and that have been prepared by the Deal Flow Facility. So this initiative was to close that gap, to work with investees who are looking to raise money and leverage some of the technical assistance that has been put up on the platform. So Financial Sector Deepening Uganda will provide an onboarding process on the platform, and where there's TA that is needed, we will invest TA to prepare these businesses and put them in a data room where investors can look in and potentially choose whether there's a match or not. So we are working on that initiative. This is the second year of that initiative. We've got lots of transactions on there, and we're onboarding more transactions. And I would encourage the investors in this room to go into the Deal Flow Facility or contact the Deal Flow Facility team that is here, sit on that platform, and this is strictly for Uganda. Maybe later on we'll expand this into other geographies, but we are attracting investors from out of the country into the platform to be able to have visibility of transactions in Uganda. The other model that we are working on, which is a secondary model, is a lot of you investors in this room are sitting on transactions. As you all know, typical investment horizon is your 10 plus 2 max. Many of you have probably done 8 years. If you were one of the early practitioners of private equity and venture capital practice, a lot of your transactions are now due for exit. So your LPs are asking you, when are we getting our money back? Use yourself, you probably are looking for your hurdle rate and your upside. So what we're trying to do on the platform is also bring investors who have got transactions to sit on the platform as well, and other investors may have an interest in it. Of course, a lot of investors are looking for primary investments and investing their equity into balance sheet to grow, but there are also others who are looking for fairly mature businesses. So there's that possibility that could happen on the platform, and I'm sure this will narrow down information asymmetry and bring to light a lot of the potential transactions that would have taken a very long time for diligence for the investors have been de-risked or prepared on the Deal Flow Facility. Thank you.
Thank you, Patrick. So as you can see, FSDU and USE have come up with initiatives again to tap into the space of alternative investments in the form of private equity and preparing companies in terms of governance towards a potential listing. So with that in mind, I would like again Bob to just give us an indication of what are the benefits of having a company listing on our stock exchanges. If you look at the region in general, East Africa, we haven't had so many listings per se, and if any, we have had the listings in Nairobi more than listings in the recent past. So would you kindly give us an indication as to how this would benefit the company and investors from having them list on the stock exchange? Thank you.
So George, thank you. So as a company, why leave your private confines and come to the public? I think the biggest driver and primary aim is to raise money. That money raised can serve different purposes. It can be to pay an existing shareholder. It can be to expand. It could also be to sort out your capital structure. Maybe you have a lot of debt in there and it is hitting you. So it's an avenue for raising capital. In some instances, I think, especially around the changing landscape around regulation and the like, you might find it's also in your best interest to cede a certain portion of your entity to fit in within the aspirations and the working of the political scenario that is existing. So it could also help you in your compliance terms. Then for valuation purposes, I think the first statistics George shared was talking about market capitalization. And this is a quickest way of getting the value of your company. And this might not have to rely so much on the assets. It's what the public is envisioning as what you're worth. Because somebody will tell you, by the time somebody spends their coin to buy your share, they think you're worth it, both in the present and for future anticipated performance. And then, of course, it gives you a good public perception in terms of awareness. It is cheap advertising, cheap public PR, because a company that is on the market must be very clean in terms of the way they do their business, in terms of taxes, in terms of their responsibility to the public and the environment. So really, among others, these are the core benefits you will get if you are willing to come and participate on the market.
Thank you, Bob. And just to augment what Bob has submitted, I remember I was advising a company, and one of the recommendations we had given the company was to, of course, sort out the CFO role. But it's not that they couldn't afford, it was actually a really big company, but it was a family-held business, passed on to the second generation, who are quite well educated. It's not like they are hearing things for the first time, but again, it just gives you a bit of insight of how some of the businesses operate here. They're not really willing to open up, and yet, in actual sense, it works in their benefit, because just like as Bob said, it gives you access to capital, to cheap capital, because people eventually will have confidence in your business. And if they have confidence in your business, probably the reason as to why they'll have the confidence in your business is probably you have a good set of accounts. Remember that accounts or accounting is business language. So if you have that in place and it's well done, then eventually people will be able to give you capital probably at lower interest rates and lower return on equity. So that's something for the entrepreneurs to think about as well. Going to the next question, which I'd like to ask both Patrick and Bob to address. So we have, I think, highlighted on what the requirements of, the benefits of listing and how you eventually get there. So if imagine you are an entrepreneur and you have no finance knowledge, what do you think would be the key steps someone would need to take from this room in order to begin their initial public offer journey? Patrick?
Well, like I said, I think the most important thing is your intention as an investor or as an investee. You need to be very clear in your mind what you want to do with this business. If you want to hold this business as a private business, there's no reason for you to even think about IPO. If you want to do hanky-panky with your business, you have no reason to go IPO, because once you go IPO, you are a public company. Your financials will have to be published. The taxman has visibility of your business. The regulator has visibility of your business. Everybody can see your business. So if you have the wrong intention for running your business, and wrong in this case does not necessarily mean the intention is bad, but if it's different from going IPO, then by all means just stick into running your small business. But if you want to go big, if you want to go IPO, if you want to exit at some point, if AECO one day lists his company and wants to sell equity and realize money, or you're a Zuckerberg for that matter, you take your Facebook onto IPO and you want to realize money, that is the route to take. And a lot of these things happen with ventures. Ventures by nature designed to be grown to a critical mass, and existing entrepreneurs exit. So the process starts from intention. So if your intention is to exit through an IPO or to mobilize additional capital over and above private equity and venture capital and debt, then you need to prepare your business. By preparing your business means attempt to prove concept. I think in the recent past we have seen even loss-making businesses, like for example Facebook, were able to go into the market and fundraise because of perception. People had hope, people had expectations that Facebook is going to grow and become a big business, and subsequently their initial par value will crystallize into an upside. So if you're able to create that vehicle, do the right things, keep your books of accounts well, build governance structures. There's a gentleman who mentioned about inability of small businesses to have proper structures and systems, and whether there are grants that exist for this to enable them prepare themselves to go and fundraise. Unfortunately, it's a very harsh world for entrepreneurs. There's no free lunch out there. Everybody who invests in your business in some form wants a return. So even the grant givers out there, and FSD Uganda is one of them, we have expectations. Our upside is public good. So even if you take a grant from a grant giver like FSD Uganda, there's still something that we take from you. So there is no free money out there to enable you prepare yourself, at least not in this geography. If you have practiced, for example, in Europe or in America, municipals usually have these grants that are available to enable businesses do exactly what you've talked about. Unfortunately, in Uganda, we don't have a very good support system. Unfortunately, during COVID, for example, a lot of our businesses did not see the austerity that the government could have given them to survive. So imagine now going out to look for money to be able to have a governance structure, to be able to have your financials in place, it's very hard to find that in this geography. But assuming you're able to do all those things, have your books well kept, have your governance structure fine, have your separation between ownership and management, and you are ready as a business. Like I said, the first step is to contact an investment banker. And there are several investment banks here who have done this advice. So what they do, like my colleague said, is to put a torch onto your business and make sure that all the nitty-gritties and the boxes are well ticked in terms of your books, in terms of your transparency with the taxman, in terms of clarity of your business model, in terms of separation of ownership and management of the business, in terms of your environmental, social, those things are now very important. If those are in place, then a prospectus will be issued. That prospectus will then now go to the Capital Markets Authority for scrutiny. And once the scrutiny has been done and there's proper transparency, then that business is ready to go and raise their initial offer. I will submit there.
Thank you, Patrick. Bob, do you have anything to add?
Yeah, maybe I'll just add a bit of just some nitty-gritties in there. So then at the starting part for somebody to come public is their legal form or legal status. Most of us, when we are starting our companies, they start as private companies. So what that essentially means is you're limited from where you can raise money. So basically, you can only raise money privately. The number of shareholders that you can take is also limited. I think as per the Companies Act of 2012, it's up to a maximum of 100. So if you're generally coming to the public, we expect bigger numbers than 100. And then the key clause is that as a private limited company, you cannot freely transfer your shareholding. So you must convert from a private limited company to a public limited company. That is step number one. So until you do that, you're not able to come and play in the public space. The other bit, and I think here I'll just be adding on what Patrick shared, is then now those internal both approvals and the like, because now when they're doing the due diligences, that is what they're looking at. Is there a board? Have the shareholders approved this action to happen? Not that maybe management is trying to sell off somebody's company. So all these must be in check and ticked off. And then lastly is the regulatory regime, because you need to have your application approved. Do you have this? If they're saying you must have maybe a minimum shareholding of or share capital of 1 billion, or do you have books or financials that have been audited by certain competence of a firm? Are you able to meet that? So it's a checklist basically, but it starts from how you're formed and how you transact, because that means there's a limitation on what you can or can't do.
Sure.
Yeah, and that's what I have to add.
Thank you. Thank you all for listening. So we'll now open it up to questions from the audience.
Lisa, thank you for reminding me. Yeah, Patrick, Bob, thanks for your presentation. I think I have 2 questions. I think the first one goes to Patrick, specifically with respect to, the motivation. Okay, I think if you look at the listings on the Uganda Securities Exchange, the bulk are former state-owned enterprises, and so the exchange was basically used as an exit vehicle for the state during the privatization process. Okay, so the private sector has not really taken advantage of this particular vehicle. So in such a case, it clearly shows that most of our businesses were not set up initially with a listing in mind. Okay, so that now speaks to the behavior of entrepreneurs, the psychology of the entrepreneurs. So the key question is, how do you deal with those kind of mindsets? How do you shift mindsets where you have a scenario where the entrepreneur actually did not or had no motivation in setting up a business to eventually list? Then secondly, on the issue of listings, public markets versus private markets, I've always asked myself the question, are we profiling an appropriate solution, financing solution, in the form of public markets? Okay, and again, speaking to the history, in Uganda, the stock exchange, public markets were introduced during the privatization process to allow for state-owned enterprises, to enable the government to divest. Okay, then after that, the question was, will the private sector take up this particular financing solution? So this was another classic case of you provide a solution, then hope that there will be a problem to take up that solution, or you provide a solution, then go look for the problem. Okay. Now, if you look at more advanced markets, the US, you look at the New York Stock Exchange as an example. You look at the reconstruction post-Civil War, the great demand for capital. This was private sector driven and not policy driven. So in our case, is a public market the solution to financing businesses in Uganda? Can we go the private route first? Can we use the private route, prepare these businesses for the rigors that come with being a publicly listed entity? Then the other thing, if you look at listings, using listings again, if you look at GDP, income per capita and listings, there's a correlation between income per capita and the number of listings in most jurisdictions. Higher income per capita normally tends to, countries with higher income per capita tend to have higher number of listings. So the question is, for a low income per capita nation, looking at that correlation, are public markets the best solution? Did we put the cart before the horse? Shouldn't we have gone the private markets route first, with the private markets providing a pipeline to the public markets, and even preparing businesses to actually go public later on? I submit.
Thank you for the questions. I think I'll probably start with the last one. And the reason why there's a correlation between GDP or per capita income and listings is because of the availability of liquidity in the hands of people. A lot of people in Uganda, if you ask, and we are going to do something called FinScope, which is collection of consumption data, to find out what percentage of our population actually saves money. So the bulk of, unfortunately, people in Uganda are living from food to mouth. There are very few people who actually save. And I wish Ayeko was here. He would have explained to you the challenges that they're suffering or the challenges that they're grappling with to build their unit trust business. So Ugandans don't have liquidity per se beyond consumption liquidity. Even when you go to the commercial banks, the bulk of loans that are borrowed are consumption loans. So in Uganda's case, I think the nascence of the stock market is a function of disposable income. It's a function of the ability for people to have units of currencies that they can put aside in investments. But also, that having been said, because of the low purchasing power that we have in this country, the return on investment on some of these listed asset classes is very, very low. A lot of these guys are offering you, and then we're having a conversation around lunch, people who invested initially in Safaricom who got dividend, they probably had to pay more money to put that money into their bank accounts than the return on investment. So the return on investment in Ugandan assets are really, really low. And even when you look at the risk profile of, for example, NSSF's investments, a large chunk of it is, by statutory requirement that should be put in the stock exchange or in publicly listed assets. But if they had it their way, they would not be putting money in those assets because it's bringing down their weighted average return on investment. So there are so many fundamentals within this geography that requires correction before we can start moving into the public source of money, because people are not looking at it as a valuable asset class for that matter. But when you look at it from the private equity side, which you stated earlier, businesses should move or raise private equity, because what private equity does is private equity brings discipline. It brings the rigor of management of businesses and creation of value. Because a private equity fund is not going to invest in your business unless you're going to promise them X amount of return on investment. And they will walk the journey with you, they will work with you, they will help you to get to that place. So I think philosophically, it is good for businesses to work with private sector, especially specialized investment vehicles like Open Capital and a few other entities out there, together with private equity funds, build these businesses, become profitable businesses before they are listed, to provide any useful return on investment for investors. Now, on the publicly listed, on the government assets that were listed, I think it was a function of policy, having adopted the structure adjustment program. The government had to liquidate a lot of the state-owned assets, but that required a process. It took a very long time for them to be prepared. Consultants were brought in from all over the world to prepare these businesses to be listed. So government is not the best runner of businesses, although government potentially could be, because if you look at a country like Botswana, all the states or all the valuable assets in Botswana are run by the state. Rwanda is trying to do that. Most of the key assets in Rwanda are being run by the state. And I think they're doing it right. Uganda could potentially have done the same, but we all know what the challenges are with this country, and therefore our best option is to go private. But I think there's a lot of work that could be done to bring a business from public, a publicly owned business by the government, to that can then be listed in the stock exchange. I submit.
Thank you. You want to add to that?
Yeah.
Okay.
Yeah, my take is a bit differing. I think the question Dixon posed to us was, did we do the right thing? I believe yes, but what did we do afterwards, I think, is where we need maybe to shine a torch to. Because in a normal journey, actually I think a few studies have indicated that if you're to follow the sequence of events, a family business will start thinking about going public or releasing some control or sharing that prosperity between maybe the third and fourth generation. So basically, if I start my company, you expect maybe from my grandson or great-grandson somewhere around there, or great-granddaughter somewhere there, to have that conversation for it to make sense. So there is that opportunity. Then now the other, and I think interesting bit is, a listing per se, or the markets are not a standalone. It's a bigger or a much bigger conversation, because you will need to talk about the savings culture, you will need to talk about some legal aspects to it. So it's much bigger than that. We can't step here and we are talking about listing and we don't have an accommodating legal environment. You're not going to talk about listing when you need investors and people live hand to mouth, as he was referring. So I think they can actually work, but we need to approach it. I believe in economics they talk about something like critical mass. can we have deliberate steps and efforts to deal with the savers, to deal with the legal environment, to deal with maybe some other micro economic variables, so that if we start saying we have a listing, then there are people with the capacity to participate. If you're saying you need somebody to save, they have some basic financial literacy to know that if you're investing, you do not expect to buy a share today and liquidate the following day, because equities really are looked at as long-term assets. So I think we need to broaden the conversation, and then that is how we can get value out of it. And then the other interventions we can do is we can skip that generational gap. And this is why I think we are talking about the deal flow facilities and a dollar, these concepts, so that we can move that cycle. Instead of it being 4 generations, you do the education, the advocacy, and it skips maybe to 1 generation.
Okay.
Yeah.
Thank you, Bob. So we'll take 2 questions at once, and I'll give the panelists a minute each to answer the question, because we're running out of time. I see there is Mr. Alfred Kabuchu has a question, and then James. Okay, I'll just take those 3. Lisa?
Okay, thank you very much for the presentation. Commenting about the listed companies, the experience has been the IPO price comes out and then it tanks after, we've gone public. Then how do we build the investor confidence for the next person who's going to list on the platform? We've just come from MTN, from 200 to about 180 or 170 right now. And I know Airtel in the near future will be coming. How do we build that investor confidence? The other thing is, yes, the question I wanted to ask, the nature of investors in these asset classes, you said they're basically consumption patterns and their savings are very small. Have we had a chance to think about things like fractional shares, so that you can deal with this critical mass that doesn't have money but would be interested in seeing another asset where they can invest to get a return? Thank you.
Okay, thank you. I hope you're taking note, Paul. Okay. James, yeah.
Thank you so much, George. The panelists have done a good job addressing the issue of preparing for the initial public offering, but I would like them to comment on the preparation for the listing of corporate bonds, because as I understand it, that market is dominated by government securities with only at least 2 companies, the last time I checked. So for the rest of us here, what kind of preparations are there to list corporate bonds? Thank you.
Okay. Alfred, just take your questions as well.
Thank you very much, and thank you to the panelists for a good discussion. I'll be quick through my questions and comments. The first one is on valuation. I'm raising it once more because there is someone from USE. You talked about MTN. I don't want to talk about it, but you also have other stocks you have there. I think like NIC. I don't know if you still have it. So you have a number of what I would call snake bite issues that you are dealing with, knowingly or unknowingly, which make potential investors not come there. So as USE, I think you need to be firm. Hopefully in the future or in the near future, when you're also preparing to list yourselves, you will go through a process that may add value to that. But valuation is very important. Secondly, I want to make a general comment that we need to always remember that our stock market works within the ecosystem of the economy. I think like one of you mentioned, there are issues to do with taxation, issues to do with cost of doing business, the issues to do with governance, not just in the private sector, but also in the public sector. There are issues to do with long-term stability, issues to do with the investable opportunities, which are still many as a growing country. So we need to always remember those so that when you are interacting with the policy makers, you bring up these issues because they're the ones that will create opportunities. Patrick mentioned that we don't have a lot of funds in the economy raised for investment, but I want to tell you that recently I saw a statistic where one of the circles made revenue of about 700 billion and a net profit of about 60 billion. And we know very well that if we come back home and we be realistic, we know that many of our people have actually invested in various circles. On average, you find a person is in about 3 to 5 circles, if we include NSSF as one of those where we are investing. So there is money that is there, but do we have opportunities where this money that has been collected by nationals can be invested on the platform? Is there something for them? And then on the USE, I think we need to go back and share what exactly is your unique selling point as USE. Why should someone come there? And if those opportunities are there, and they are actually many, why is it that many companies are not coming to list? So maybe you need to go back and reassess yourselves, reassess the market and the way you are operating, and maybe you'll find something, get feedback from potential companies that would list and do understand maybe there's something that you are not doing well, or maybe there's another market that needs to be developed. Thank you very much.
Thank you. All right, Bob, I'll let you address the question relating to valuation, especially after an IPO, and then corporate bonds, and whether you have any other platforms. And I think all the questions are you're in best position to answer them.
Okay, so one, I want to thank our audience for the questions. And I'll, I think, start from Alfred. I think he put a question of valuation. And I think it goes to the same question the gentleman raised. Now, valuation is an interesting and sticky issue around IPOs. Because yes, there are professionals who do valuation, but really if you go in the depth of it, evaluation done by a professional is a professional opinion. Now, when you'll find from, and I think I've seen Dixon might have left, but when it comes to that point, from a regulator point of view, as long as it is something that can be defended, because before we accept evaluation, at least we'll try and see the methodology somebody went through. So you will get that professional opinion and you come with it. At least if it looks fair, that is when they will, but really there's not so much room. You can make that person, as long as at least it is something that can be rationalized. Now where I think he was raising the point that why do they come, let's say, at this price and after some time it goes down. It tells you that is the market appreciation of the company. Because ideally, we expect some of the investors in here to go in, look at the financials and say, you might have, in quotes, overvalued your company, but what the market actually gives it, because it means it's backed by demand. Someone will say, I'm willing to buy your stock at this price. So it means that's how they have appreciated it. If somebody also feels that, you know what, it is okay for me to sell at that, then it is the market that is communicating. Of course, some people or some sections of the market have said that, you know what, to make this, maybe, how it is, can you sell at a discount? Of course, now that is a management's decision to take. Because it could be one way of trying to address it. but they also need to look at their figures and decide. So that is the challenge around valuation. But we believe if somebody has fairly valued their company and priced it properly, then the market will always flow along. Because I'm sure there are some issuances we have seen where a company is floated and the price starts going up. So pricing for an IPO becomes a critical element. It of course starts from the valuation and then the other considerations you put into how you set the IPO price. So at least when we interact with these issuers, we try to share with them these insights. Because from a regulation point of view, as an issuer coming to the market, we will not say that we are prescribing that this is the price you must come to market at. Because also if you poorly price it, maybe it will be undertaken up. You'll find it comes to allocation and you wanted 50% and people are saying 20%. So basically it is from the company and the public has the right to state what they think is. I think that is important to know. But we always advise, value, and then go behind and do a price with your advisors that will make sure that the company comes to market, one is fully taken up, and can continue creating value for both the company and its other stakeholders. Now, I think there was a question around corporate bonds. So if you're to issue a corporate bond on the market, you'll find the requirements are still the same. Because we'll need, for you to raise money from the public, it still has to be a public company. You have to show what you intend to use the funds for. You have to see that certain guidelines are in your corporate governance, because that all affects the ability to repay. Because for somebody to lend you money, they are interested in just ultimately, will I get my money back? So all those requirements that can ensure that must be in place. But in terms of requirements, there is really no huge difference from when you're coming for an IPO.
Okay, thank you. Then there's a question from Mr. Alfred in relation to the various platforms or products that you're probably coming up with.
Okay. Yeah, so on the supply side, that's why we have come down to say, you know what, can we actually start interacting with this? Because most companies come thinking they can do an IPO, but they have never had an interaction with the markets. They just have no idea. Actually, we normally have very interesting conversations. And someone says, okay, now, my things are here. Are you giving me money tomorrow? And they're like, no, these are the markets. It doesn't work like that. There's a process and certain procedures that you need to first qualify for. So one intervention is our EDALA, where I was saying, let's talk to you before you even think about listing. But this is who you are, this is what it would require, but you can start from here. Step one, maybe you organize and you meet some of our audience here, and then start the journey. Maybe private equity, equity 1, equity 2, then maybe eventually you exit through the market. The other one, and I'm not sure if most of our audience is aware, there is a solution we call listing by introduction. You might not actually you're not raising money. You're just saying, can I also participate on the market? So you basically come to get listed on the market. The point you ever want to raise money or do anything on the market, then you're already there. So this is also an option that you can take as a company. Then we have, I think most people tell us there's the big boys market and maybe the one for medium and growing enterprises. GEMs. So that is also an option, and where you come and sit and interact with some of your potential investors so that you get to understand what they're interested in. If it can be provided, then they are willing and ready to participate in investing with you. So really the options are there. All we request is some of you, the advisors, to have conversations. At least what I know is our door is always open, and we converse and see how to give solutions. Because at the end of the day, we exist to provide other solutions to businesses in terms of raising capital.
Thank you. And just to add that Mr. Kabuchu's question in relation to valuation. So speaking from an investment banker's perspective, once you establish your professional opinion of what the valuation is, you normally now start approaching some of many of the institutional investors who have the big pockets to see whether they agree with your valuation before you actually go to the market. So by the time you eventually list on the stock exchange, that valuation would have been probably discussed with some of the main players in the market, NSSF, Gen Africa, and Sanlam, all these other big institutional investors, to gauge their appetite as to whether they are quite interested in the opportunity and the valuation that is proposed is accepted. So that way you limit the risk of having an undersubscribed IPO. Yeah. So thank you very much. Let Lisa take over.
Thank you. Members, we are almost at the tail end of our program. Please let's give the discussants another loud round of applause. Thank you for those very insightful thoughts. Thank you for being with us for 2 days since yesterday up to today. We are almost concluding. Just briefly, we will have brief remarks, like I'd mentioned earlier, from one of our partners, IAVCA, briefly in 2 minutes, and it will be followed by UAP, brief remarks. I would have spoken on behalf of DPF. We are also one of the key sponsors of the event, but as you have been seeing on the screen, for us, we went digital. But nonetheless, we shall receive from IAVCA, and then we shall also receive some few remarks from UAP. You're most welcome.
Thank you. My name is Doris Acheng from IAVCA, which is short for the East Africa Private Equity and Venture Capital Association. So for those not familiar with IAVCA, we are an industry body representing the interests of private capital providers across East Africa, with our scope of operations including Kenya, Uganda, Ethiopia, Rwanda, and Tanzania. So in terms of what we do on behalf of members, it's along 4 pillars, which is advocacy towards enhancing the ease of doing business environment for private capital providers, intelligence to facilitate market entry and expansion decisions, as well as events and trainings for our members to strengthen relationships and provide platforms for knowledge sharing. So we would like to thank the CFA Society immensely for this fantastic event and for providing a platform through which conversations around private equity could be had. It is the first step in mainstreaming an industry that is likely to bridge Uganda's financing gap. We'd also like to share some developments that have taken place in the private capital industry in Uganda, both at macro and market level. At a macro level, the Capital Markets Authority, which is the regulator for the private capital industry in Uganda, has been actively pursuing reforms to make it possible to have a homegrown private capital industry, and has been active in engaging investors in pursuit of this. I won't repeat many of these as reforms, as Mr. Keith mentioned, some of the work that is being actively pursued and in the pipeline in his remarks yesterday. But just to summarize, these include conversations that have primarily been around enhancing the enabling environment for local domiciliation of funds in Uganda. Some of the proposals being pursued include revising the restrictive definition of what constitutes a private equity fund in the CMA Act 2016, and expanding the fund structuring options available to funds that are looking to domicile in Uganda. On the latter, the CMA has been active in addressing the question of what needs to be done at a regulatory level to encourage more domiciliation of funds that are looking to invest in Uganda or the East African region, and more so from the perspective of expanding fund structuring vehicles available to homegrown private capital funds. The CMA's significant and continuing efforts, we hope, will provide greater incentives for local domiciliation and expand the pool of private capital available to Ugandan enterprises. We, as an industry, appreciate the weight that the regulator is placing in driving and sometimes initiating some of these conversations in its market development role. At the market level, we are seeing some progress as well, with investments primarily driven by East African focused funds, which have typically provided the vast amount of capital coming into Uganda. These have and continue to invest in early and growth stage opportunities, with the health, manufacturing and energy sector attracting the most interest. Last year, we also saw the entry of investments from private capital providers with a global geographical focus, with many of these exploring opportunities in non-traditional sectors, such as fintech, mobility, and clean tech. This is promising, as it shows Ugandan companies are investable and can compete head-to-head with other comparable African enterprises. On other fronts, DFIs continue to play a role in expanding the pool of private capital available. We are glad local DFIs are also seeing the opportunity in equity-like investments, either directly or through intermediation. The emergence of homegrown funds is also promising, and particularly because these have a passion and vision to invest in Ugandan companies, and is evidence of momentum in the industry. All these developments show that the private capital market is on the move. We are excited about the next chapter of the industry. Thank you.
Thank you so much, Yavka, for those very, very, very insightful or informative session. I think we are all delighted to learn about the works of the association, but also the great support that we are seeing from our Capital Markets Authority in terms of pursuing reforms to make the alternatives investment space more accessible, but also especially in terms of the regulation. Thank you so much. Just to invite UAP briefly, 2 minutes. We appreciate the support. UAP, like I mentioned earlier, is one of our sponsors for this event. As DPF, we went digital, but we also appreciate that we'll be able to interact with Zach face to face. Thank you.
1 billion, 2 billion, thank you. Okay. Okay. Lisa, you're eating in my time. Yes, thank you so much. Yes, my name is Zach Kisesi. I work with UAP Old Mutual Financial Services. The UAP group has 4 subsidiaries in Uganda. 2 of them are insurance, that's general life business. The third is a properties company. We have only 2 properties in Uganda. One is Nakawa Business Park, where our head offices are. And the second building is UAP Insurance Building along Kimathi Avenue. So I'm wearing the hat of the fund manager, who is UAP Old Mutual Financial Services. We are, of course, regulated by CMA and UBRA. So I'm just going to read a speech that was given to me by our managing director, who briefly stepped out. I know he'll be here in just a few. And that is going to definitely, I hope I can do it in 2 minutes later. Lisa, you know I'm a man of few words. You know that's the case. So Old Mutual has always been a proud sponsor of various CFA programs in Uganda because we believe in the philosophy of having the right professionals with the right qualifications heading investment decisions across the financial spectrum. As David Wangolo, PCP, said yesterday, let the professionals do their work. So you need the professionals to do their work. Do alternative investments matter? In class, we always say that alternative investments are actually older than traditional investments like bonds. Bonds are not many years old, but alternative investments have been there for over 1,000 years. So the question is, which is the alternative? But as Lisa rightly put it yesterday, we hope the conference answers the questions which there was a neighborhood which she talked about, and she hoped that those residents, I think she meant the locals out there, the real market, will be able to be sorted. But as a stakeholder in the financial space with a mandate to prudently invest stakeholder money in very profitable, risk-adjusted return businesses, the AI conference has made us look at alternative investments with a broader perspective. Yesterday, Kim Kamareve, managing partner in Inua Capital, highlighted the high tax rates of up to 80% that PE firms are subject to. Today, we heard from Rutega Simon, consultant with BOU, about the goal of creating 75 to 80,000 mortgages in the next 4 years. The deficit will still remain huge because he talked about close to 2.5 million units needed. And the truth is, it's every person's dream of owning their own home. So this AI conversation will go on long after this conference, because who better to develop Uganda than the Ugandans themselves? Foreign investors take their money out, but it's the Ugandans themselves who may have to go into investments that may not necessarily be profitable in the short run, but have an impact to future generations. Yes, we need the roads, we need the affordable housing, we need the successful agribusinesses, even if long-term bonds, government bonds, may be more profitable. Success has a short memory, with many successful businesses looking obviously in the now, yet with a long history of many failings. Collective investment schemes, for example, where Old Mutual is a market leader, look successful now. But did you know that the first CIS was registered in 2004? For 10 years, there was no traction. Most success has come over the past 3 to 4 years. So we need patient AI investors who will have small successes to build a track record for others to pick up from. As Mr. Patrick Oketa said a few minutes ago, a few years ago, most analysts were hired from Kenya, but now it's a different story. So, on behalf of Old Mutual, we would like to give our commitment to the CFA Society East Africa to strive to keep contributing to developing the capital markets, and with other investment partners like those in the room, surely our best days lie ahead. Good evening.
Thank you so much. I would have given Zach a gift if he had actually used 2 minutes, but you tried. I'll still give you my gift. I appreciate. We shall have our final and official closing remarks from the organizing committee, and that will be by David. But just before David, my colleague, Sam, whom I appreciate so much for the support during this conference, had another engagement, so he had to leave a little earlier. But from ourselves, myself and Sam, would like to appreciate all of you, our participants, for being an active team, actively participating, and the patience that you exhibited during these last 2 days. You have been a very great team, and you made our work very easy. So let's clap for ourselves. It would be unfair if I did not recognize the panelists, discussants, who, from the deliberations and the deliverables that you have received over the last 2 days, seen that these were men and women who took their time to organize and prepare to make sure that what they deliver in this conference was top-notch and it was befitting, or it's befitting of the great audience that all of you are. We also appreciate them for that. Our sponsors, I would just like to read them briefly. Capital Markets Authority, UAP, Deposit Protection Fund of Uganda. Your deposits are protected. Uganda Retirement Benefits Regulatory Authority, Deal Flow Facility, European Union, our partners, event partners, ACCA, Open Capital, FITSPA, Gen Africa, Asset Managers, PAL, Marina, Uganda Securities Exchange, BDO, TASLAV, Yavka, those not to mention but a few, and then last in our own capacities, I believe David will be able to make the official one, would like to extend our appreciation to the society, just to mention a few that we've been coordinating with very closely to make sure that this event is a success. Ruth Amongin, it would be unfair if I left this stage without recognizing your diligent and selfless participation, or the effort that you put in to make all of this. We are all here because you put in a lot of extra time. We appreciate you. David and Alan, indeed your shoes are so wide. We don't know if we would ever be able to fill them, but we continue to appreciate the pace that you leave before us. And lastly, I would like to take this opportunity to invite you, David, to come and make your final closing remarks, because I don't have that capacity. Yes, thank you.
Ladies and gentlemen, it's a great honor to have had you here over the last 2 days on the inaugural Alternative Investments Conference promoted by CFA together with its partners, particularly YAVCA and the Capital Markets Authority, sponsors and partners that have been mentioned by my colleague Lisa. We are truly honored to have managed to host you over the last 2 days. We really thank the caliber of the speakers that was here and panelists who offered their free knowledge and time over the last 2 days to ensure that the delivery and material that we're getting was top-notch, and we were getting very high-level information in regard to where the private equity industry is going, where the alternative industry is going, and I think you have left this conference a lot richer than you came. We also want to thank all our members and delegates, that have braved the weather, the traffic, and stayed over the last 2 days to participate and engage in this conference for the betterment of all of us to learn. I especially also want to recognize charter holders, recent, who managed to increase our charter and members of the CFA Institute by 11 or so members on the Uganda chapter, which brings us closer to 60 or 65 members overall out of 300 in East Africa. You would like to imagine that we were just 5 or so over 10 years ago. So these are, Kega numbers that represent tremendous growth in the profession, and the belief that the profession defines a step in the right direction for the investment industry going forward. I would like to also especially thank our service providers, Mestil Hotel, and the guys doing the video and sound. I must say it was crisp, and we've not had any technology challenges during the conference, and everyone managed to be able to have the visuals, such a beautiful visual, have the conference go through, see what's happening, continue to get the right level of feedback and engagement throughout the conference. So I want to really thank the guys behind the machines. You're little recognized sometimes, but we really wouldn't have had a great conference without the great display and sound output that is out here. In a special way, I would also like to recognize the organizing committee, there are a couple of members who have dedicated an inordinate amount of time to ensure that this conference goes well. I know they've been mentioned by Lisa, but I would like to mention them again. Ruth, Eric, really want to appreciate your hands-on approach. Our MCs, Lisa and Sami, who is, I think, left. Would like to thank our colleagues in Nairobi. Would like to especially also recognize members of the board, George, Alan, who have been instrumental in mobilizing resources. And I'd also especially like to thank Alan, with whom I was co-chair of this conference, in terms of the fact that we moved together and he provided a lot of support in regard to reaching out to sponsors. As part of the final words, I would like to say that alternative investments are going to remain an important part of our discussion going forward. We hope that this room has provided the springboard upon which we can move forward in determining the direction that this industry takes. This, as you can see, is a very important industry that needs a lot of collaboration and coordination with its different players, right from advisors, investors, to the practitioners, to the entrepreneurs. And so there's a very wide ecosystem that has, up until now, been quite disjointed, and because of that, we have always been left behind. But I think we've made the step in the right direction. The step in the right direction has enabled us identify what the challenges are in our industry. The step in the right direction has identified the opportunities and risks. The step in the right direction has enabled us exchange business cards, network, and identify which people are responsible for knowing what to do within this industry. And with that step in the right direction, I think we can say that the Alternative Investments Conference 2023 has been a tremendous success, and we look forward to having you in 2024 with stories of different levels of success, achievement, and areas that we can grow. So together with the CFA Society, our partners and sponsors, I would like to declare this conference closed, and a big round of applause to you, ladies and gentlemen, for making this a big success.
Ladies and gentlemen, we have prepared some few, what am I supposed to say? Okay, you're most welcome for another session for networking. No, I'm not opening again, it's been closed. Just networking in the hallway. For those who would like a cup of tea, it's available. Those who would like the stronger version, it's available. The medium version, it's available. If you need a stronger one, we can make available, because we want to make sure that you can get to your destination safe. Kindly note, exit or leaving shall be at leisure. Please join us for our networking session. You are most welcome. Thank you again. I'm too addicted to hauling a sente. Tally on expiry date.